Hey everyone, Andy here. So this year has been a whirlwind of events, and that's clearly been reflected in the stock market. In February and March, we had some of the worst market decline in history, and then the past 50 to 60 days have been phenomenal. And I think this has given a lot of people a good opportunity to reflect on their risk tolerance. And this is a big question for a lot of people. How much should I be invested in stocks versus bonds? Should I be an 80-20 or 70-30 or 100-0? The answer to that is really dependent on what we call risk tolerance. When people say risk tolerance, they generally think about, well, how much loss can I afford to lose, or how much loss can I stomach before I feel like I just need to get out? And that's part of it, but determining your risk tolerance is really a lot more than figuring out what you can handle behaviorally. So when you're determining your own personal risk tolerance, which ultimately determines your asset allocation, so that balance between stocks and bonds, there are three things that you should consider. Number one is your need to take risk. Number two, your ability to take risk. And number three, your willingness to take risk. So let's start with that first one, your need to take risk. And this is really a function of how much you need to earn to achieve financial independence. So the more that you need to earn, the more risk you're going to need to take, and the more you're probably going to have to shift your portfolio towards equities versus fixed income. Now, this is dependent on several factors, like how much money do you have saved away right now? How much are you actively saving? And how much do you expect to spend during those non-working years of your life? Another factor you need to consider is what other kind of income sources do you expect during your non-working years, like Social Security or rental income. And all of these are going to influence how much risk you need to take. For instance, if you already have a huge nest egg stored away, you probably don't need to put away as much as if you were approaching retirement and you didn't have that much saved, in which case your money's probably going to have to do a little more work for you. So in that case, you might need to take on more risk. Same with retirement lifestyle. If you plan to live a relatively conservative lifestyle in terms of spending, then you probably don't need to take as much risk as if you have the intentions of living a lavish lifestyle during retirement. So there are many factors to this one, but it primarily depends on the amount that you need to earn in order to accumulate enough to provide for your lifestyle during those financially independent years of your life. Number two is your ability to take risk. And this is primarily dependent on your time horizon. So how much time do you have before you're going to need to start withdrawing from that portfolio to live on? If retirement / financial independence is 30 plus years away for you, then you can afford to take more risk, because if and when the stock market crashes, you have plenty of time to see it recover before you actually need to touch that money. Where if you have income needs now or in the near future, you really can't afford to take that much risk because you're going to need that money to live on. And third is your willingness to take risk. And this is a very important one, and it's really dependent on how well you can sleep at night when there's volatility in the stock market. So this past February and March, ask yourself, were you staying up at night? Were you stressed throughout the day? Not due to the virus, but due to the movement in the stock market? If so, then your willingness may be less than you originally thought. If not, and you didn't even think about it, it's temporary, it's going to come back, then you may have a higher willingness to take risk. And one's not worse than the other, it's just an important part of your overall risk tolerance. So your true risk tolerance is really the balance between all three of these things. It's the intersection of your need, ability, and willingness to take risk. Those three all need to be in balance, because it's what ultimately determines what percentage of your portfolio should be in equities and what should be in something safer, less volatile, like fixed income. And there's no one right answer for everyone. So while using a formula based on your age may get you part of the way there, it's only one piece of the puzzle. There are many factors that are unique and dependent to your specific situation. So what's right for you may not be right for somebody else. For instance, you may have an ability to take on more risk, but you're not willing to. Or you may have a willingness to take on more risk even though you don't need to. Each one of these serves a unique purpose and is really important for your financial success. So whether you're working with an advisor or working on your own, I think it's critically important to understand yourself and your unique goals and circumstances, because there truly is no one size fits all. Hope this was helpful. Have a great week.